Okay, welcome back. I'm still your host, Dr. B. You guys know me. Uh, Macroeconomics, we're going to talk about savings, investment, and the financial system as a whole here in the United States. And I'll put a fun spin on it, and we'll talk about it from the perspective of 2022. So it's really important that you save, okay? Especially now during a time of high inflation. Save, save, save. Okay, please save. If you're not hearing what I'm saying, I'm telling you to save your money. Okay, in the bank. Don't go buying stocks with it right now. Not a good time for the stocks. 2022. Save your money. Okay, in the bank account. Don't spend too much of it. Okay, right now we're going into recession. We have inflation and recession in 2022. Okay, 2023, the same, more the same. So please save. I want to talk to you about savings, investing, and the interest rates that affect these things. This is probably the most important part here. The financial system, the way it works here in the United States is we have a central bank. The central bank helps the regional banks and the overall economy when it comes to saving and investing. We call this a group of institutions. It's the central bank, it's the local credit unions, the national banks, all of these together, these institutions, make up the financial system. And we also have that's on the savings and investing side, but we also have on the investing side, we have the stock markets. Yep. These institutions work together to help match the savings of one person with an investment of another. Yeah. We call this the financial system. Financial institutions, the banks, okay, help you, the saver. Please save your money this year, please. I'm asking you politely. Save a little bit more this year than you did last year. This year's not going to go so well. Okay, so save. Which will help savers directly provide the funds to borrowers. When you save money in the bank, I'm going to ask all of you this question. This is a good question. So, feel free to unmute and tell me your answer. My question to you. Or you can just type in the chat yes or no. Do you think that when you put monies in your savings, that physical money is in the bank? You save money.
No.
Is it physically in the bank?
No.
Miss Anthony, no.
Not really.
No.
Like digitally, yes, but physically, no.
Yeah. I like that answer.
Technically it's there, but it's not because they invested or something or put it somewhere else.
Like give it to lenders, like use it for loans for people, and even if they don't pay back the loan, the bank will still have your money there.
Yes.
I know that for sure.
Yeah, no, you're right. You're absolutely right. Yeah, that was fun. Okay, Ethan, you said something that was spot on. You said digitally yes, but technically no. Can you elaborate on this?
I mean, you said is it physically there? Like, no, your money's not physically there. Like, not all the green money is not there, but like digitally you sent it to the bank, so by default, yes and no.
Yeah, you're right. Yeah. So
Can I stretch that a little bit? Can I add something to that? What he just said?
Yes, Miss Anthony, please.
Because meaningly, like when you saying it's there digitally, yes, you can see it on your bank statement or on your phone under your bank app, saying that you actually have this in your account. But like he said, unfortunately, it's not there in green money for real. You have to set up that to get the payments. You have to set up appointments to get the payments.
Yeah, that's true. Yep. So what? And to add on to that, so I know none of you are around for this. 1929, the great stock market crash. You probably read about it. Maybe you read about it. So in 1929, there was a great financial stock market crash. Okay, we're talking catastrophic. 25% of the entire U.S. population was out of work. The market just collapsed. Okay, and so what happened was everyone who had money in the bank no longer trusted the banks, so they all went to the banks at the same time to withdraw all of their cash. Back then, there was no digital. Digital didn't exist in 1929. So, what happened? The banks didn't have all of the cash because, like you said, the banks use the cash to then lend to other people or to companies or whatever. Your grandmother told you, yes, yeah. This was This was what started the Great Depression. Yep. And so the stock market collapsed. The people ran to the banks all at the same time. They wanted their money, and not everyone got it. This was a collapse of the financial institution. So what banks do is they use your physical money that you deposited, and they lend that to other people. So to answer the question, digitally, yes, it's there. Technically, it is there. Physically, it is not. Okay. The bank doesn't have this huge vault. Every bank doesn't have this huge vault with $1 trillion in it. It's just not physical possible. Yeah. So yeah, that's the way financial bank works, is that the savers are technically providing the funds to the borrowers indirectly through the bank. Well, that's what a financial institution is. So it's interesting. It's interesting to say the least. I always ask, every time I teach this class, I ask that question because it's always fascinating to hear your responses, because not everyone knows this. Not everyone knows that the bank doesn't actually have the cash there. So now that you're like, dang, I had $1,000 in the bank. I wonder if it's actually there. No, it's not. It's technically, physically not there. Digitally and technically, yes, but physically, no. Interesting. Financial markets. Savers can directly provide funds to the borrowers. Absolutely. You can lend money to someone. You say, oh, Dr. B, do you need some money? I'll hook you up. I'm going to charge you interest, though. I'm not borrowing money from you guys. But you see what I'm saying, yes? The bond market, we talked a little bit about stocks and bonds in accounting, for those of you who remember the conversations we had on stocks and bonds. A bond is how a business owes money to someone else through a bond. Bond is like a loan, very similar to a loan. Yeah, works the same way. A bond is a certificate of indebtedness. It's a loan. It's the loan document. Yeah, a bond. There's a market for bonds. People buy and sell debt. Yeah. There's also, as you know, the stock market. The stock market is where people like you and me own shares of a company. We own shares of a company. So if I have a share of Starbucks stock, I technically own a part of Starbucks. It's a very small part. But it represents my share of ownership. We call this a stock. Yeah? A stock is a claim to partial ownership in a company. That is what a share of stock is. And we have what's called the stock market, where we can buy and sell our shares of stock. There's always a middleman when it comes to money, okay? Always a middleman. We call these financial intermediaries. Institutions through which savers can directly provide funds to borrowers. A bank is an intermediary. You, the saver, have a savings account at a bank. You put the money into your savings account. The bank then lends money to someone else. The bank is the intermediary. A mutual fund is kind of a form of an intermediary. Let me explain this one to you. Mutual fund. Mutual funds are really good investments. They are, I promise. A mutual fund is a really good investment. I always recommend to anyone who listens to me about finance, I say, instead of buying individual stocks on the stock market, you should buy mutual funds. And they say, why? Why, Dr. B? Why should I buy mutual funds instead of buying shares of stock in Microsoft or Facebook or whatever, big tech, I say, well, because when you buy one stock in one company, it's very risky. What happens when that company loses money? You're not going to get your investment back. Okay? So that's why I say buy a mutual fund instead. A mutual fund is simply a portfolio of a lot of different stocks and bonds in one portfolio. Okay? A mutual fund is a lot of different stocks, so a lot of different companies and different industries, etc., and some bonds, etc. They're very low. The risk is pretty low with a mutual fund, but the return is also not so high. So low return, but also low risk. Yeah, mutual funds are a good, steady way of investing, and they're relatively safe. If one small stock within the mutual fund goes down, okay. If they all go down, that's not so good. But if one goes down, there's a good chance another one's going up. So the net change isn't very, very high. Oh my goodness, yeah, 2008, 2009, those were bad years. I think most of you were probably around for this. So 2008, 2009, the banks did not do so well. The banks kind of overlended to people who should not have been borrowing in the first place. And it caused a financial crisis around the world, which led to a very deep and long-lasting recession. That recession lasted a long time. Here in the United States, it lasted for a real, real long time. It was probably one of the longer ones we've had. It went from about 2009 through about 2015-ish, 14. Yeah, so it was a long time. A couple reasons why this happened. The housing market collapsed. But the reason why that happened was the banks lent money to people who wanted to buy houses that those people were not eligible for the loans. People with bad credit scores, a bad history of making payments, etc. But the banks just kind of looked the other way and gave them the money anyway. Well, what do you think's going to happen? That's like going to Dr. B saying, "Oh, Dr. B, are you worth the investment?" Well, if I have a history of not paying people back, do you think you're going to lend me money? No. I wouldn't lend me money if I have a history of not paying people back. We're not going to pay you back. I have a history of not doing it. So why did this happen? Chiquita, great question. Why did this happen? Well, the banks wanted money. The banks wanted to get rich, okay? So what they did was banks were giving people mortgages shouldn't have been able to get a mortgage in the first place because the bank wanted interest. Okay, they got greedy. They got greedy. Yeah, they got greedy. So, if somebody has a bad credit score, they're going to pay more in interest. That's just the way that works, okay? You have bad credit score, you're going to pay more in interest. Because the bank sees you as a higher risk. That's why that credit score, I hate to say that it's important, but it kind of is. In a way. Only if you're going to buy a house. That's probably the only reason. Otherwise, try to pay cash for everything else. It's not good to go in debt for any reason, honestly, other than a mortgage. My point is, the people that were taking out the loans, the mortgages, they didn't have good credit scores, and they didn't have a good history of paying the loans back. The bank said, I'll give you that loan, but you're going to pay 13% in interest instead of 6% or whatever the going rate was back then. People took it out anyway. They had second homes, third homes, whatever. And people stopped paying them back. Well, of course, that caused the housing market to collapse. Nobody's paying their mortgages back. So the banks go and foreclose, meaning kick the owners out, because they didn't pay the loan. You don't pay your mortgage, you're going to be homeless real quick. Okay? You have to pay your mortgage. So people stop doing it. Now they're homeless. And now the housing market's collapsing because now we have a bunch of foreclosures. And then that caused the banks to start collapsing because they weren't getting paid back. And so it caused the market to tank. Yeah. And then unemployment went high because the market started collapsing. It just was bad. And so, because of that situation, no one was getting any loans from the banks. The banks didn't trust anyone, and nobody trusted the banks. So 2008, 2009, we had the credit crunch, was what they called it. And that led to the economic downturn because, well, if the businesses couldn't get loans to expand the business, they can't get more employees, right? We see. And this causes economic downturn. And so, it caused unemployment rates to rise and GDP to fall. And they called this a vicious cycle because, you can't sell the assets, right? Reduces your profits, and it makes the situation worse. And that happened for a while, unfortunately. The better part of 7 to 8 years. So yeah. About 8 years. It was a bad time. 2008 to just a couple of years ago. So anyway, gross domestic product is, as you recall from previous chapters, we use this to determine the overall financial health of the country. And the formula, as you remember, is consumption plus investment plus government purchases plus net exports equals gross domestic product. So let's assume that we have what's called a closed economy, meaning that everything we make in the country we consume locally. Okay, so no exports. It's a closed economy. In this case, consumer spending plus investment plus government spending would equal the GDP. So if investments equals GDP minus consumption minus growth, we can add in savings. The savings rate for the country can be calculated by gross domestic product minus consumer spending minus government spending. So gross domestic product minus consumer spending minus government spending equals country's savings rate. Therefore, the savings rate is the same as investment in a closed economy. Closed economy simply means, again, that there are no exports. We consume everything locally. This is not true, right? The only places a closed economy exists is in North Korea and probably a few other communist nations. For taxes, take the taxes minus transferable payments. So your savings rate equals your gross domestic product minus consumer spending minus government spending. This can be rewritten as savings rate equals gross domestic product minus taxes minus consumption. I'm sorry, consumer spending plus taxes minus government spending. This is a way to account for the taxes, right? For a private savings individual, let's say you're saving, please, 2022, save money. Gross domestic product minus taxes minus consumer spending, you spent some of your money, equals your savings. That makes sense, right? Your gross domestic product, paycheck, minus your taxes, minus your consumer spending equals your savings. That makes sense. It's your private savings. For public savings, meaning the government savings account in the United States, your public savings account. Oh, well, okay, so maybe it does. The government does have a public savings account. It's called Social Security. Okay, so Social Security, pretend is public savings. It's the tax revenue that the government takes in minus all the money the government spends. It's the public savings. It doesn't really exist in the United States. That would be called a government surplus. Our government does not have that in the United States. We've been running a deficit for a real long time. I wish I had a surplus, but our government's too dumb to figure out that they're spending too much money. Okay, budget surplus. This is true in the state of Maryland. We had a budget surplus in the state of Maryland over the past few years. We took in more taxes than the government spent. It's a good thing for the government, yeah. Not necessarily for the people, but for the government, it's a good thing. So it's the tax revenue minus government spending. If it's greater than zero, then we call that a budget surplus. The opposite, of course, is true for the federal government. The federal government has been running a budget deficit because they can't figure out how to stop spending. It's the tax revenue minus government spending. If the tax revenue is less than the government spending, then we have a deficit. Oh, isn't that amazing? I'm not going to go through this example. It's a good one. Feel free to go through it on your time. I want you to kind of grasp the concept. It's very straightforward, I promise you. It's a straightforward concept. That's why we're skipping through this learning activity. Okay, what is savings and investment? So private savings, again, 2022 and 2023, I want you to save money. Please, I'm asking you very nicely. If you don't have a savings account in the bank right now, open one up and save some damn money. I promise you we're going to run into a serious recession soon, which means that you need to save money now. Private savings. It's your income. After you spend money on your taxes and you've paid for your spending. You bought some groceries and stuff. So whatever you're left over with at the end of the week or the end of the 2 weeks, that's your savings. Okay? So save that money. What do you do with your savings? Well, I want you to save it in your checking or savings account. That's what I want you to do with your money right now for 2022, 2023. But what else could you do with it? You could buy a bond or an equity. You could purchase a certificate of deposit at the bank. You could. I wouldn't recommend it. Or you could buy shares of stock of a mutual fund. I don't recommend that for 2022 for sure. Okay. I want you to do the last thing and save it in the checking or savings account. Oh, Chiquita. That is a question I'm going to answer, and you're not going to like the answer too.
What's the answer, Professor? I need to know because I think that
it is no. It is not an asset.
Why not?
Because you can't take it with you. Oh, well, let me explain. This is the worst type of investing you can do. It is to buy what we call a whole life insurance policy. A whole life insurance policy acts like, I will use this very loosely, acts like a high yield savings account. It is not. And here's why. The insurance company uses the money that you quote unquote save in your whole life policy when you die. Obviously, that's what the money's there for. When you die, the insurance pays out to cover the final expenses. Yeah. Your funeral expenses, whatever's. Okay? If there's anything left over, which in most cases there's not, they keep part of it, and then whatever's left goes to your beneficiary. So yes, term life insurance is much better than a whole life policy. 100%. 100%. Sorry, I'm sure you didn't like the answer, but that's true. Yeah, so if you have a whole life policy, cancel that shit immediately, get your money back, and go get yourself a term.
But doesn't term last like for a certain amount of years,
Yeah,
though, and then it restarts?
Yeah, that's
or
why we call it term. Yeah. It's typically 10 years, so you get 10-year policies at a time. The good thing is that as you get older, hopefully, you should be saving.
Interest. Yeah, it draws interest.
Exactly. So as you get older and your savings, you'll be able to balance that out. Okay, so the short answer is the term life policy is much, much better. Great question. Good discussion.
But I can still borrow from my whole life insurance policies as well, Professor.
At a
But
very high interest rate.
Yep, very high.
Okay.
It'll cost you more than it's worth, I promise.
Yep, especially right now.
Especially right now because interest rates are ridiculous due to this recession.
Very much so. I have a cousin that's in life insurance policies, and that's what he's selling, life insurance policies. So he instilled in me that yes, a term policy is the best policy, especially right now, and especially like Dr. B said, when the next round we are definitely going into a deep recession.
Yeah, there's no doubt. So yeah, I would definitely do term. That is my recommendation. I'm not legally. Oh, I should put that in this my disclosure. Okay, my disclosure. So Miss Chiquita, don't go suing me now. Okay, because I told you to do these things. I'm just giving you advice as your friend and your colleague, not as an insurance person. Okay.
That's fine, Professor. I have one more question. I know that you
Yes.
don't, but I
Yeah.
know you have more knowledge than I do.
You
Okay,
tell me.
so with the term insurance, because my brother was trying to tell me that that was better for me to get versus whole as well, but I convinced myself that whole was better. So my question is, once you invest all of that money into the term policy, after the 10-year period, do you get that money back, or does it continue if you want it to? How does that work?
You just pay for it again. It's kind of like think
So
about
all
like
the money is gone?
no. So with a term policy, it's not like a savings. Okay, it's not like a savings. It's different. It's like your car insurance. Okay, the term life insurance policy is like your car insurance. You pay it every so often to renew it. Okay, and when you die, it pays out whatever amount that is. So let's say, Chiquita, you go get yourself a 10-year term life insurance policy that pays out $100,000 when you die to your beneficiary. Okay. When you die, as long as that insurance policy has been paid, it will pay out the entire $100,000 to your beneficiary. Okay, so it's like more like auto policy. I know it sounds weird to say that, but I hope that helps. Yeah. So cash out in your life policy, put that money into your savings account at your bank, and buy yourself a nice 10-year term. All right, cool. Okay, yeah, cash them all out then and put it in your savings account and get a 10-year term. Make sure if you're married or if you have other people, make sure they get one too. Okay. Okay.
Yeah, I think I messed up, Professor, because I have like 7 different policies on people, but it's whole insurance. And my kids, I have whole insurance on them as well because
Cash
I
that
thought it
shit
was a
out.
good policy. Cash,
Cash,
okay, so you
cash
making
it.
me feel bad like I invest, and I've been
No,
paying on it for like
no,
10
no.
years.
I just don't want it. I just don't want to see you get stuck with some bad investment decision.
Okay.
Yep. Just cash them out, put it in the savings account, and get everyone term policies.
So I'm entitled to all the money that I'm invested back.
Absolutely. Yeah, that's your money.
Okay. Okay. Thank you.
Yep. You might have to fight with them to get. They're a pain in the ass to deal with. So it's an insurance company. They're always a pain. But anyway, sorry about the side discussion. But yeah, those are the things you want to do. So private savings, yes. Investments, purchasing of new capital. Companies like to invest in property, plant, and equipment. For individual investing, stocks and bonds. Wait, okay? Wait on the stocks and bonds. Wait till the market bottoms out before you do any stock investing. That might take a while. Loanable funds market. The system is designed where the savers, of course, lend the money to the borrowers. That's the way the financial system is designed. Government policies, of course, have impacts on these things, as you know. Government policies impact the savings rates, investment rates, and interest rates. In 2022, since we're dealing with inflation, the only way that the government can combat inflation in their minds is, of course, to raise the interest rates. Why do they do this, you might ask? The reason why governments raise interest rates during times of inflation is to discourage people from borrowing and spending money. Okay? We make the interest rate go up, so therefore you borrow less or you don't borrow at all. Yep. Hopefully, eventually it will come down. Yep. Yeah, Ethan, no worries. Have a nice day. Yes, Rochelle, no worries. We'll wrap up here shortly. I will see you next time. Yeah. So savers save, the borrowers borrow. The interest rate is affected for both savings and borrowing. Savings rates, they're not the greatest. You know, my recommendation, go with, if for banking, I always recommend the federal credit unions. Yeah, the local ones. Federal credit unions are the best. The reason why I say that is because their savings rates are much higher than they are at a national bank like Bank of America or whatever. Uh, usually and typically, if you're a member, if you and you need a loan, the interest rate's usually pretty reasonable. So the supply of loan money comes from those who save. Remember that savers who save ultimately are lending the money to the borrowers in through the bank. Yeah. And it kind of works that way in the public sector as well. It's a little different. The supply of money, supply of actual currency, slopes upward and to the right, just like supply normally does. The higher the interest rate, the higher the supply. That makes sense, right? The banks like to make their money. They'll give you more money at a higher interest rate. That's the way you think about it. They'll give you more money at a higher interest rate. Demand for funds comes from investment. Companies need to be able to pay for new property, plant, and equipment. How do they do that? They take out loans from the bank. Yeah. Just like an individual needs a loan from the bank to buy a house. Now, look at the demand curve. When demand is high, the interest rate is high. A lot of people want loans. It's what the bank, they're going to have a high interest rate. When demand is low, the interest rate is lower. Make sense? Of course, there's the point of equilibrium where demand equals supply, which gives us what we call equilibrium interest rate and an equilibrium loanable amount. So for savings, it's the same concept applies. The more savings, the lower the interest rate, typically. Of course, lower demand when there's more savings. Yeah. Think of it as, opposites. Higher interest rate, higher demand, and higher supply. There's a shift in the supply curve, meaning there's less money in circulation. Demand typically goes up, which raises the interest rate. This is what the government's currently doing to combat the current inflation situation. The idea is to take money out of circulation. That's why the interest rate is going up. But really what the government needs to do is stop spending money. That's how we're going to get out of this thing, but you know how that goes. Government borrows money to finance its debt, which is ridiculous, but that's what they do, leaving less funds available for investment. We call this crowding out funds. Uh, the U.S. government has been running a deficit for a real long time. It's unfortunate, but true. We're in the trillions of dollars. I think it's like 16 trillion or something like that right now. It's bad. It's real bad. They're trying. I quote unquote trying. The government needs to take in more tax revenue and spend less money in order to reduce the deficit. It's really easy. But our U.S. government is not that smart. And this is what's. It's much worse than this now. This line is like high. Yeah. It's a very high percentage of GDP now. It's like 90%. It's really bad. So yeah, that's kind of where we're at. Questions, comments, or concerns about the financial system, savings, investing? Yeah, they spend money that they don't have. That's right. They just keep printing it, and that's why we have inflation. Ain't smart. Okay. Comments, questions, or concerns? Okay, I hope I entertained all of you at least a little bit, kept you awake, and had some fun with it. To remind you of what's due Sunday, Chapter 12 quiz, Chapter 13 homework. Both are true, false, multiple choice, about 5 questions apiece, 2 attempts. You know the routine. If you have any comments, questions, or concerns, you can always email me, call me, set up office hours. Whatever you need, I'm here for you all the time. I wish you all the best. Thank you so much. You guys are doing so well. I'm so proud of all of you, especially your performance on the midterm exam. Very, very proud of all of you. You make me very happy. So keep up the great work. Let's keep up the positive momentum. Don't slow down now. I want to see you all succeed. Enjoy the rest of your evening. Thank you so much. Take care. Do the best things. Wash your hands. I'll see you next time. Bye-bye.